You're listening to Mr. Credit on San Diego 1700 with local credit expert Derek Evans. Now, live in studio, Mr. Credit.
Welcome to Mr. Credit. We are live and local here in San Diego, bringing you the most important hour in radio. Today we're going to be talking about bankruptcy, different types of bankruptcy, how a bankruptcy can help you keep your home and avoid foreclosure, and then, of course, how you can recover your credit quickly after bankruptcy. And, you know, a lot of people ask me, Derek, why are you so in love with bankruptcy? Why is it that you talk about it so much? And really, I just want to make sure that everyone's fully educated about your legal right, because you have a legal right to file bankruptcy if you're in a position to qualify for it. And most people, they hear the word and they run and hide. They think it's something horrible. And it certainly doesn't have to be. It can actually be something that's very good for you and your family. If you're on Facebook, do a search for Mr. Credit. You will find me there. You can email questions to me, askmrcredit@yahoo.com. Yesterday we had Ed Paula, loan modification expert, in the studio, and we had some great questions. I got one after the show that I want to read now because it really makes a great point that we didn't make yesterday. Mr. Credit, the bank rejected my request for a loan modification because I was not late on my payments. The reason for my applying is because I have a high debt-to-income ratio. The bank gave me 3 months reduced payments, then informed me that I had to start the process over again. I'm having a problem with filing again with the bank, and now the bank, of course, said I'm late on the payments because I'm late. I want to stay in my home, but what can I do? My advice to Nikki was this. There's two things you need to do. Number one, call Ed Paula. Don't waste any time. 866-870-8282. He will be able to tell you whether or not you're running circles around yourself and chasing your tail with this loan modification situation. He'll be able to tell you probably just based off the bank that you're working with. Number two, contact William McDonald. If you want to stay in your home and you want to keep it, you don't want to go through foreclosure, if your loan modification isn't going to work and you don't want to short sale your home, call William McDonald. A Chapter 13 bankruptcy will allow you to stay in your home. You can keep your home no matter what situation you're in. Doesn't matter. You can keep your home with a Chapter 13 bankruptcy. So if you qualify for it, which most people will, in a Chapter 13, remember what you're doing. You're consolidating all of your debts and you're agreeing to pay back what you can afford to those creditors over a 3 to 5 year period. You can do that with your home as well. Your home is included. So you can keep your home by doing that. Call William McDonald for a free consultation. He'll tell you if it's something that makes sense for you. 858-437-0103. Now, a lot of people come to me with the same scenario, except for it usually begins with, well, our loan modification is in process. I didn't get the 3 months reduced payment. It's just in process. So what are we supposed to do about this? Another thing to consider, Nikki, as well, is potentially a Chapter 7 bankruptcy where you can wipe out your debts. You said you've got a high debt-to-income ratio. Typically, what causes that is credit cards. Remember, credit cards, they're the necessary evil in credit scoring. You've got to have them. If you don't have at least 3 credit cards, you're missing points on your credit score. And if you don't have any credit cards at all, you're missing up to 35% of your credit score. So you have to have them. But they are nasty. I mean, they are tough. If you don't manage them very, very diligently, they can catch up to you very, very quickly. And what happens is the terms are revolving on credit cards. So that means that they can change. Now, the CARD Act, which was recently implemented in February, does help with this somewhat. But the terms can still change. If you become late, they're checking your credit all the time. When you have a credit card, that company who you have the credit card with, that bank, they're checking your credit on a regular basis to see exactly what's going on. And if they see you getting higher balances on your credit cards, your overall debt ratio is getting high. If they see you're missing payments, if they see you've done something, you've missed a payment somewhere, or maybe something else has happened, another card has closed you out, they'll start to put the squeeze on you. That means they'll increase the interest rates, they'll increase your minimum payments. And this is what happens. People get a credit card because it's a 0%, and the payment on $10,000 is only $150 a month. But once something happens or once that time expires, that initial period expires at the 0%, you go and pay the full interest, and then your minimum payment becomes 4%. Now it's $400 a month. So if you have $40,000, $50,000 in credit card debt, you're easily paying $2,000 a month to go nowhere. And this is typically what happens when someone has a high debt-to-income ratio, is because the credit cards have come to get paid. And you're paying interest. You're not even getting anywhere. So I always think that the smartest thing you can do is become 100% educated about what your options are. Ed Paula can help you with your loan modification, and William McDonald will be able to tell you whether or not you should look at Chapter 7, Chapter 13, or neither. Either way, you've got solutions. You can stay in your home. You don't have to lose it to foreclosure. No matter what, there's a way to keep it. If it's not a loan mod, then maybe it's bankruptcy, but you can keep it. And I think that's important today because a lot of people don't want to lose their home. Maybe we can't afford the payment for one reason or another, but we don't want to lose it. We want to keep it. And there is a way that you can do that. So that's a little bit about how Chapter 13 bankruptcy works. Now, if you want to email me, you can email askmrcredit@yahoo.com or go to mrcreditradio.com and do the contact form there and get to me either way. But we want to talk about Chapter 7 because I always hear this, well, I hear you talking about bankruptcy all the time. Why is that? Well, it's because Chapter 7 bankruptcy is one of the most interesting, unique, and truly amazing financial tools that exists. And I hear people all the time, this is my favorite line, where's our bailout? They're bailing out the banks, they're bailing out everybody. Everybody's getting a bailout. The car companies get the bailout. The banks get the bailout. Everybody's getting bailed out. What's our bailout? Your bailout's been there since the 1800s. I mean, Abe Lincoln filed for bankruptcy, for crying out loud. That had to be back in the 1800s somewhere. So your bailout's been there forever. That's what bankruptcy is. Now, why was bankruptcy created in the first place? What's the purpose behind it? Well, our country is a very entrepreneurial country. It's based on capitalistic principles. And the idea was we want to encourage people to go and start businesses. But we need to give them a parachute. We can't just have them jump out the plane and hope the landing's soft. Because most businesses do fail. The majority of them do. In fact, the high majority of them do. So what are we going to do that allows people to go out and try to start businesses to create growth in our economy and jobs and revenues for taxes? And everybody wins when we start businesses, right? Well, we're going to give them the ability to file bankruptcy. Because if it doesn't work out, that's your bailout. That's your parachute. And you can pull it technically every 8 years if you wanted to. You could try to start a new business. If it didn't work out, boom. Are there people who abuse it? Of course there are. Of course there are. Are there people who abuse everything? Of course there are. But there's no sense in talking about those people. Those people have theirs coming to them when their time comes. But for the people who have a lot of credit card debt, or want to stay in their home, or have bad auto leases, or have judgments, or having your wages garnished, there's a solution there. You don't have to continue to do that. Now, it's your right. It's your legal right to file bankruptcy. It's also your legal right to continue to go as you're going. You could continue to just make minimum payments and not get anywhere on the balances, or try to chunk a little bit here and there and hope that you don't use the card and run it back up. You could do that too. That's your legal right. You could do debt settlement, which I highly do not recommend. You could also do that, destroy your credit for a few years. With the Chapter 7 bankruptcy, the reason that it's so amazing to me as a financial tool is because your credit score is most likely going to go higher afterwards. Remember, when you discharge an item in bankruptcy, you are removing the negative information that's associated with that account. It's removed. It's muted. As long as it's filed properly, of course, by the creditor. If it's not, I'll help you fix it. It's just that simple. So when you have 10, 12, 15 different accounts that you're including in bankruptcy, and you remove all the negative information that's associated with those accounts from your credit report, and all you're substituting is the bankruptcy public record, which does as much damage as a 90-day late payment on any type of account, any car, any credit card, any mortgage loan, does the same damage that any judgment for $100 or any collection that you get for not paying a parking ticket has the same effect on your credit score. So you can see why it's something that it's really is amazing for you to be able to maintain a good credit score potentially. Now, you will be a different credit risk, obviously, for a couple years. You're going to have a different situation when you're applying for loans because they're going to ask you if you filed for bankruptcy, and you're going to have to say you did. But from a credit scoring standpoint, you can have a 700 score 90 days out of discharge almost every time.